Dave Ramsey's investment advice. What is he thinking? I just got this post that he put on Instagram sent to me by one of our students. I looked at it and look, I have a lot of respect for Dave Ramsey, all right? He does a lot of good things for many people. He helps people become debt-free, right? That's his goal, that's what he works for, and then to invest for financial freedom, which is great, and he does great things. I'm a big fan. But this advice was really bad, and I felt I had to go in and respond. So basically what he said was that you should invest in only two things: mutual funds and real estate paid in full. Now, obviously, I'm a big fan of him saying real estate because we're Momentum Property Education. By the way, I'm Daniel Wood. I'm one of the founders of Momentum Property Education. And I obviously like that. But you don't have to necessarily do it paid in full. There are so many ways to go down the real estate route. But before that, I want to talk about mutual funds. Now, Dave, if you're watching this video, have you read what Tony Robbins did when he created Money Master the Game, the research he did, the interviews he did, and what he found on mutual funds? If you did, all I can say is like, really? How can you be giving that advice? How can you be advising people to put money into mutual funds? Now, the statistics that Tony Robbins found, doing all this due diligence, talking to the wealthiest people in the planet, you know, right? The founders of Vanguard, you know, you got Ray Dalio, Warren Buffett, all these amazing people are interviewed for that book. And what he found was that 96% of all mutual funds fail to beat the market. Plus, they charge enormous fees that make their results even worse. So you're paying all these fees to have a 4% chance of beating just the market average. Now, that's not the same 4% every year. It's a different 4% every year, meaning on average, you'll produce a lot worse. So he says clearly, do not use index funds. That's nuts. Warren Buffett has said one thing for people who do not have experience in investing, that don't have the time to read reports, is do index funds. That gives you the market average. So why would you ever pay the fees of a mutual fund when it's essentially free to use an index fund? So that's my first big point there to you, Dave, is why are you telling people to use mutual funds? They're expensive and they don't produce good results generally. Just put the money in an index fund. That will give you a better result. Now, the second part with real estate, great. Real estate, that's brilliant. If you can cash real estate, that's great. But you can use leverage. I know that Dave Ramsey's whole thing is don't have debt, don't have debt, don't have debt. But if you're investing in real estate, you want to have some debt. You want to be able to utilize the growth in the value. You want to be able to reinvest in more properties and grow your cash flow. Now, you don't have to be doing 75, 80, 90%. You can be doing 50%. You can even do 40% loan to value. There is value to having some debt in your portfolio. So that would be my comment on real estate. Plus, you don't actually have to buy the property. You can use lease options. You can use seller financing. You can use rent-to-rents. You can use joint ventures so that you're buying the real estate without using your own funds. We've found 25 different ways to fund a property deal. Just check out our Passive Income Mastery episode from last week. We covered 25 ways to fund your property deal in just 60 seconds, so check that out. Now, for the things he said not to invest in, there are some interesting things too. Some of them I agree with, all right? But some of these we got to get into. Now, one of the things he said was do not invest in bonds. Now, I agree, do not invest in junk bonds, all right? But there is value to invest in government bonds occasionally. It's something that, again, I'm going to refer to Money Master the Game. Tony Robbins talks to Ray Dalio. Ray Dalio creates together with him their all-weather portfolio. And in that, they do have some government-backed bonds because of the stability of the income and the backing by the U.S. government. So there is some value to using bonds. It's not high return, but, you know, if you're advising mutual funds, you might as well advise bonds. He also advises against single stocks. Now, again, yes, most people shouldn't be investing in single stocks. It's better to choose index fund, not mutual fund, index fund, all right? But if you are a fan of Disney, if you do your due diligence, if you see that Disney's a good company, you know, why not? Why not get some Disney stock or Amazon or Netflix, a company you believe in? Yes, what I tend to recommend, what Tony Robbins recommends, what T. Harv Eker recommends, what Robert Kiyosaki recommends, lots of people recommend, is you have different, we call them buckets, right, for your investments. You'll have one that is your safety bucket. That's where you might have your bonds, your other commodities like gold. You'll have one that is your stable rainy day fund, right? What Dave often talks about, 3 to 6 months of security, right? You might just have that in a bank account that gives you a straight interest, right? And it might be even zero, but just to have that safety in case something happens. And then you'll have your kind of high risk fund, your play fund. You might as well put some money into some stocks you like or you believe in there. Why not? You might get lucky. You might do good. And if you lose it, that wasn't your key investments. That was your risk bucket. And same thing there. He says, do not invest in Bitcoin. Now, cryptocurrencies are risky, right? There are risks to it. So you put that in a special part of your investment portfolio. But Paul Tudor Jones, one of the most respected investors in the world, actually went out on the news and advised people to have 5% of their wealth in Bitcoin, which is pretty significant. Now, in more private circles at Tony Robbins' Wealth Mastery, he actually advises people to invest as much as 20%. So there are some different views there. So you can put some money into Bitcoin. There are so many options. I think there's things you should avoid, there are things you should do. But what's important is not saying never do these things and you should do these things. You should not do any investments until you understand it, until you learn it, until you study it. If you understand the investment, then you can do it, right? So if you want to get into real estate, don't just cash a property randomly. Do your due diligence. Figure out, is this a good property deal? And if it is, go for it. Same thing with stocks. Don't just go like, all right, I want Disney. No, you do your due diligence. Is it a good buy? Is it a good future? Does it have a good opportunity? Then you buy it. Same thing if you're going to do cryptocurrencies. Is it a good buy? What's the future? What's the opportunity? There is knowledge out there. There's lots of it here on YouTube. We cover it every week on Passive Income Mastery. But there are also a lot of other channels that give a lot of value. So you can always do that. And I always advise you to find a mentor that can advise you and support you. Now, I'm not going to help you with stocks. I'm not going to help you with cryptocurrencies. That's not what I do. I have mentors that help me with those investments. But what I could help with is the property side. So we all have our strengths and weaknesses. Our strength here is property. So if you want to learn more about passive income, about investing, make sure you subscribe to our channel. Thank you so much for joining. And hey, for those who are fans of Dave Ramsey, so am I. Okay, I am a fan of Dave. I just did not agree with this advice, and I just felt I had to say it. So I apologize if anyone took offense, but it's important that we're doing smart investments for the right reasons with the right people. So good luck, bless, and thank you so much for watching.